Welcome back to the Just Build Baby Studio. You're listening to the BuildX Podcast, your ultimate guide to creating exceptional homes, innovative spaces, and staying informed on all aspects of residential building technologies. I'm your host, Buzz Artiano, and together we'll explore the strategies, techniques, and insights that transform ordinary houses into extraordinary homes. Today, I'm excited to have Jane McCarthy in studio with us. Jane is a reverse mortgage specialist at Right Key Mortgage with over 30 years of experience in real estate and mortgage lending. Jane, welcome to the show.
Thank you so much for having me.
So I like to start out in the beginning and just kind of take us through your journey, your last 30 years, how you got from, how you got started in the industry into where you are today.
Well, I've been in real estate.
As a broker?
As a broker. I hold a broker's license in real estate. I've been doing that about 24 years. Raised 2 boys and a husband. Don't tell him I raised him, but I really did. Anyway, and during that time, I also got my mortgage loan originator's license. So I've been in the mortgage industry about 11 years, and I'm also a licensed real estate instructor. So I'm licensed by the state of Massachusetts to teach the licensing course for anybody who wants to become a real estate salesperson or a broker. So been doing that about 10 or 11 years as well. So I've got a combined experience in the real estate industry for over 30 years, but awesome. All aspects real estate. And
but take me back before that. So how did you get interested in real estate? Take me back to the early days, before you did all those great things.
Before I did all those great things. All right, so I went to Bryant College when I was much younger and graduated Bryant College with a degree in marketing. I was in the promotional products business, really. So those hats, those mugs, those shirts that you're wearing, that was the industry that I was in until I was about 30, 31. Then I decided to make a career switch so that I could be more local to raise my kids and got my real estate license. I was always interested in houses. When I was younger, I was trimming the bushes and mowing the lawn and making my parents' house look beautiful. So it was always something I was interested in. And I really felt that with my sales experience in business-to-business sales and my background and my marketing degree that I would be kind of just prone for this type of career. Yeah. So, and it would give me the flexibility to be where I needed to be, which was be a mom.
Sure.
And and I can't help but grow. So in the course of being a real estate agent, the first thing I did was got my broker's license when I could, because I can't help myself. And then I was given the opportunity to get a mortgage loan originator's license, so I did that. And just around the same time, I got my instructor's license because I really am passionate about teaching people. I feel that knowledge is power, and you need power in order to purchase, right?
There you go. Good stuff. So your office is located where?
Easton. We are in South Easton.
Mass. Okay. Yes. And you work out of that office, or you work from home?
I'm hybrid. I can go into the office. Most of us are working out of our home and seeing clients on site, whether that's in their home, whether that's at an open house, whether that's, here at a podcast studio, right?
There you go. So I know one of the reasons we started talking, obviously, is I'm pretty passionate about accessory dwelling units, and you said, I have this really great product that's going to help my ADU customers. And I said, what's that? And you said it was a hammock?
Well, you can sit on a hammock, or you can get a Heckham. It's your choice.
Yeah, so you said it was a Heckham. See, I'm still learning. So the Heckham stands for?
Home Equity Conversion Mortgage.
Right. And so that is sort of a reverse mortgage?
It is a reverse mortgage.
Okay.
It is the big fancy name for reverse mortgage.
All right. So let's start at the beginning, and we're going to try to unpack this for myself and for my audience, right? So I want to purchase. I'm going to give you a scenario, right? So I want to build an ADU, and I need money to do that. Tell me how your product. Give me a scenario where your product fits into that scenario.
Okay. So,
And let's make it as real world as we can. No names, obviously, but a scenario. This one, all the chess pieces, etc.
okay. So first, let's define what a
All right,
reverse
good
mortgage
stuff.
is.
All right, let's do
So
that.
let's define what a reverse mortgage is. A reverse mortgage allows a borrower to borrow against the equity in their home. Okay.
The current home.
Their current home, their primary residence. All right.
Got
That's the terminology we're going to use.
Okay.
Primary residence. All right. And the amount that they can borrow is determined by their age, the value of the property, and interest rates.
Okay.
Okay? So unlike a HELOC, where it's a set standard, let's say you could go up to, let's say, 70% of the home's value, it depends on how old the homeowner is, how old the borrower is, right? Now, to use a...
Wait. Let me stop you there. So, I need more explanation. So, on a HELOC, I have to prove I have a job, I have income.
Yep.
Correct? And my age is irrelevant, but
Correct.
the value of the home and my income is really what it's driven on.
Correct.
Right. On a reverse mortgage, the income doesn't matter?
There is not an income calculation like in a forward mortgage, which is what
Okay.
you're talking about.
So we're looking strictly at how old I am.
Correct?
So they're banking on how long I'm going to make it,
That's right.
right? And what my house is worth minus any debt that I have.
Correct.
Okay. So now take me to the next step. So now I have Mr. and Mrs. Smith. They're 70 years old, and they need to do a reverse mortgage. It could be to build an ADU. It could be just to live on, whatever that is, right? We can spend the money on whatever we want. Mr. and Mrs. Smith can use that money however they want, correct?
That's correct.
All right. And they get it in a lump sum or they get it monthly?
It's their choice.
Okay. So I can say I want my $200,000 now, and then I know, so I don't make any payments,
Correct.
right? Or I can say I want $1,200 a month, and same thing, I don't make any payments.
Well, it's determined by, once again, the borrower's age,
Okay.
which there's a minimum requirement that they're 62 years of age or older.
All right, so you have
that-
to be 62 or older.
You have
okay?
have to be 62 years of age or older.
All right,
The next thing is, what's the value of the property,
All
as you
right.
said? And then if there is a current loan on it, a current first mortgage, that would need to get paid off with
okay.
the
So
home equity.
so the reverse people have to be in first position.
Correct.
Okay.
Correct.
So if I owe $100,000 on the house still, and I get a $300,000 reverse mortgage, there's only $200,000 for me to collect in any manner I see fit.
It's going to have limits. So you can have, there's a first year maximum draw,
Okay.
okay? And then after that, it allows you to take what the balance is. But once again, it's not one predetermined amount. If you're 62, you're going to have less
All right. Let's
equity
right.
available because you have a longer lifespan. Do you see what I'm saying?
So I know I'm going to put you on the spot here, but let's
okay.
just play some scenarios. So,
Yep.
husband and wife are, I'm going to make them both the same age. They're 70 years old. They have $1 million house, and it's paid off.
Mm-hmm.
What's that scenario look like? How much can we get? How long to get the first 1 year payment? What's that amount? What's the percentage?
I'd have to put in a calculation to know exactly how
Roughly.
much they can get. So
Roughly.
let's say they can get, if it's $1 million house, they own outright.
Correct.
Okay? Let's say that they're 70 years old, so they have available $455,000. Let's just use that
Okay.
number.
Well, let's use 500. It's an easy number. So
Okay.
they have 500.
They have $500,000 in equity available.
Okay.
There'll be a certain percentage of that they can take out as a maximum on their first year. Now, could they take it? There's a calculation that's used to allow for how much they have access to as a maximum on a monthly basis. So, for example, they could say, well, I only need $1,000 a month. Can I take $1,000 a month? Or I need $50,000 to pay off some debts. I really don't want to have my car payment anymore, but I like my new car. I have a credit card debt, or I need to put a new roof on my house.
Got it.
Okay? And so they could have some expenses that they want to take what's called an initial draw.
Okay.
All right.
And that is typically what percentage of that?
It's not one percentage because it's based on the age of the borrower.
Okay.
Right? So you can give me
So it's a
three
sliding
scenarios.
scale. So
Correct.
If I'm 90 years old, they're going to let me take more or less?
Correct, more.
Because they're banking on me not making it as far.
That's correct. But my odds are with you. I think you'll go pretty far.
So I'm 90 years old, and I can take a much bigger draw. If I'm 62 years old, they're not going to let me get as far into them because they're planning on me having a longer runway.
That's correct.
Got it. Okay. So I can take an initial draw of some percentage. The older I am, the bigger percentage I can take is the initial draw.
Correct.
And the larger monthly payment I can take as an initial draw too? I mean a payment if I'm older?
That's correct.
So my monthly stipend would be larger the older I am.
So in the scenario that you gave me, let's say the borrower has $500,000 in equity and they say, you know what, I'm just going to leave it as a line of credit. I'm not going to take anything, but I do want to take a monthly draw. So that monthly draw will be much larger than if they took, let's say, $100,000 out of that. Because it's one pot. Think about the stew.
And it doesn't replenish.
Right.
So whatever, if you're taking $1,500 a month, or I'm going to use $2,000 for easy math, so I'm taking $2,000 every month. So every year, my $500,000 is going to go down by $24,000
plus interest.
The interest is accruing along the way.
Well, think about when you pay.
Got it.
A loan.
Yeah, I got it. So the interest is based on the $500,000 or what I've taken as I'm
what
taking.
You draw.
Okay. So the interest doesn't start until I start taking money, and the interest is only on the amount of funds that I've taken to date. So every year, if I take $24,000 every year, then the following year is another 24. So now I'm paying interest on 48, and so forth and so on until the end, where I can't take any more money, and now I'm out of money. And so the idea is they're trying to time you out so that you croak when the money runs out.
Well, the money doesn't in essence run out because you can actually take more. You can live in that house for as long as you need to.
Oh.
Okay? So you could end up actually, and we call it upside down, right? Where you owe more to the lender than what the house is worth.
Right.
Here's the thing with a HECM or reverse mortgage in today's world. They are non-recourse, which means that the borrower is not responsible for that excess debt. So let's say we have initially $500,000 worth of equity, but this borrower is an overachiever and they live to 110 years old. Okay? So instead of, remember, your house is growing in value. So there's an amortization schedule that we use to calculate what the expected value of your home is by the time you're, at your anticipated life expectancy.
Right.
So when I talk to a borrower, I give them this amortization schedule and say, hey, look, I know you're worried about owing more than what, the house is worth come, the time that you no longer need the property. But here's a calculation on what we anticipate that to be like. And that means that we value the property at a 4% rate, 4% appreciation every year. And then we show what the interest is that accumulates on that borrowed money. Now, your borrower who takes $500,000, they live a long time, they end up owing, their house is, let's say, worth $1 million, but they end up owing 1.2. They're only liable for what the appraised value is on that property.
Got it.
Okay? And the heirs, the key is that the heirs can buy that for 95% of that.
Interesting.
Right? So you think about that. The biggest concern with a reverse mortgage...
Wait, I'm going to stop you there.
Okay.
So that's a lot to unpack.
Yep.
So I'm going to start again. Mr. and Mrs. Smith is 70 years old. They're taking $500,000. At year 80, let's say 30 years, they've expended the whole $500,000 in whatever. They've taken it monthly, they took a few payments, whatever it is. And now there's no more money to get, correct?
Mm-hmm.
Right, we only get one bite at that apple, or we can go back and say, now my house is worth $2 million, I want another $500,000.
So there's a couple ways to do this, right? And that's why these things are so intricate, because if you take it all, that line, so let's say you're taking $100,000 out of that $500,000, that means you have a $400,000 line of credit that grows at the same interest rate that it costs you to borrow that money.
Got it.
So if the interest rate is 6% or 7%, that balance that you have in there, that equity that you have, is growing as well.
Okay.
So there are a couple of moving parts here.
So this is you have to have, well, first of all, you need to have someone that knows what they're talking about. So thankfully we have you in studio today. And all right, so let's just play that out. So now I'm 80 years old. Unfortunately, I passed away. My wife is still alive, and now she wants to sell the house because she's going to go build an ADU and live somewhere else. So she owes the $500,000 plus whatever accrued interest.
Correct.
And I'm going to just use round math and say that's $700,000 now. Okay. And you're saying if the house appraises for $1.5 million at that point, we can just sell the house and pay off the $700,000, or do they get a piece of the upside as well?
They do not get a piece of the upside.
Okay.
Unless they'll get reimbursed.
Right.
For what is owed on the loan.
Plus the accrued interest.
Correct.
Right. And the accrued interest there's no ever payments made to the interest, so obviously it keeps compounding. As the longer you go, the more you end up paying, obviously. So if we have excess equity at the end, we've expended our $500,000, we've disposed of the property, and we still have money left over, we get to keep the money left over.
Correct.
Okay, that's good. I like that. Now, take me to your scenario about buying. So let's pretend for a minute that the value of the house has gone down to $700,000, and the appraised value comes in at $700,000, and we owe $700,000. You're saying that the heirs can pay it off at 95 cents on the dollar?
Correct.
Interesting. That's very interesting. So if there is a dip in the values of property, unfortunately, if you're selling or your demise doesn't line up with the market, there is the most you're in exposure of is 95% of the debt.
That is correct.
So let's unpack. So give me, again, no names, but give me some scenarios why people would be interested in this product. What are the stories around this? Because this is fascinating to me.
So I have a 90-year-old borrower, right? Sharp as a whip, right? Has the ability to live in her own home, does not want to move, has lived there for 65 years.
Right.
And is having a challenging time making ends meet.
Okay, so whatever expenses she has are exceeding what her savings and or income is.
Correct. Her Social Security, pension.
Right, and so the real estate taxes, the car insurance, whatever it is exceeding her monthly income.
Correct.
And so, okay, so now what? So she's taking that money to do what? To live on.
She's taking that money so that she doesn't have to stress over going to the grocery store and making a choice between a hot dog and a lobster for the remainder of her life, because she's worked and done all the right things,
right,
and has this house that is a huge chunk of change sitting there,
right,
and can't enjoy it.
Untapped equity.
Yeah,
right.
Can't enjoy it.
Yeah, illiquid.
That is correct.
Illiquid. Interesting. Right. So she's sitting in a house that's worth $1 million, and she's counting pennies just to have breakfast.
That is correct.
Interesting. So, all right. So that's one scenario. That makes sense to me. What's another common scenario that you see?
So the other common scenario is when people get behind in their real estate taxes and their insurance, because their real estate taxes and their insurance are the second largest chunk, right, of what they have to spend. So maybe they can make their expensive, maybe they can buy their groceries and do those sorts of things, but now they're having a hard time. They're falling behind on their real estate taxes, and we all know what can happen when you do that.
Yeah, you're going to lose your house.
That's right.
Yep.
So what we can do is that this can be set up for a LISA, a life expectancy set aside, which means that they keep a pool of the available funds in the equity aside and make the payment on your taxes and insurance.
Wow. Okay, so you can designate it up front saying this amount of money is going to go to this expenses so that my house doesn't get taken away from me.
That's right. That's right.
Fascinating. So obviously there's some advantageous tax reasons for doing this as well, because obviously if you have $1 million house and you haven't done estate planning and then you pass away, then there's a big tax bill due. But if you lived off of $700,000 of it, now there's only $300,000 left to pay taxes on.
I'm going to defer that to a tax accountant for.
Well, we have one. We have one coming in a couple weeks, so I'm going to give them that scenario. But I think that's right. And we also need to think about the whole Medicaid clawback on that. So that's interesting as well. I'm going to unpack that with a couple elder law attorneys we have coming in shortly. So that's going to be a good subject. I'm going to make sure we explore that. So we can have set-asides, or we can say we're 90 years old and I've always wanted to go see Spain and I'm going to take my trip and go.
That's right. That's right. This is about aging in place.
Yeah, it's pretty cool.
This is about aging in place, which is exactly what your ADUs are doing. That's exactly what they're doing.
Yeah, I just don't know how we can use this to build the ADU because, well, I guess we could. So let's talk about that for a minute. Let me give you a scenario and tell me. You stop me when I hit the wrong thing.
All right, let's do that. Let's do that.
We need a buzzer in here. We need the "you're wrong" buzzer. Patented. So I'm going to pick on Mrs. Smith. She's 80 years old and she lives in the family home. Her husband has passed away, unfortunately. And she is having trouble living alone. Emotionally, physically, whatever it may be, right? But she, again, I'm just using round numbers, she has $1 million house and they have no mortgage. And she has enough money to get by, but no extra money. Her child, who lives 30 minutes away, I'm just going to use Jane, right? So Jane lives 30 minutes away, and her house she's run out of room in her house. But the mom has a big house that was a family house. And she says to Jane, you sell your house and you come move to my house, and then we're going to build an ADU in the backyard and I'm going to live in that. Now I'm going to pretend that Jane doesn't have much equity in her house.
Okay.
She bought it, recently, and she only has enough to close on it and maybe get, 25, 50 grand, whatever. And she's going to come and occupy the family home. Now the question is can Mrs. Smith, mom, James' mom, take the reverse mortgage money? Can she take that money and build an ADU for herself and move into it? Does it still all work because it's on the same property?
That is correct.
Okay. But she can't take a big chunk of money up front.
So first year, there'll be a limit on how much she can take. So timing, so planning is key.
So we don't know what that limit is, though.
It's based on her age,
Right.
value of the property.
Okay. But it's not, if she has $500,000 coming to her, it's not, she can take half.
Once again, it depends on her age. Yeah,
So
exactly.
she's 70, it's
Yeah.
probably not half. If she's 90, it's probably she can take half.
Probably.
Yeah, okay. So there's some formula in there,
Correct.
right? So that's interesting. So then how do we help Jane's mom get enough money to build the ADU in that scenario so that Jane can sell her house and move in and the mom can live in the ADU?
Okay, so Jane's mom needs to do a little planning and think, okay, this is how I want this to go. Number one, there's a few things that are going to happen, right? First of all, Jane needs to get her house ready to sell and put it on the market. So timing is everything. So if she decides to do a reverse to do this, we do the application and we time it so that her first year maximum withdrawal is your down payment, right? And then the build happens through the beginning of the second year.
So it's a 12-month look back.
It
doesn't-
depends.
So if you close in January, the following January, you can start with more money.
That's correct.
It's 12 months. It's
Correct.
not calendar year, it's
No, it's 12 months.
12 months, okay.
Yep.
So, but here's a question for you. So if you have a reverse mortgage, can they get a second behind the reverse mortgage?
So can you get a second behind the reverse mortgage? That's a possibility. Really good question. You will not be able to keep that first mortgage in place. That's going to have to get paid off.
No. So the house was paid off.
Yep, house was paid off.
The house
They
was
take
paid
out
off.
a reverse.
I take out the reverse mortgage with Right Key Mortgage,
Yep.
right? Jane McCarthy to the rescue. And now I have my $500,000 secured. But again, I'm just going to use round numbers. I need $250,000 to build my ADU in order for my daughter, Jane, to move into my house, right? But I can only take, again, I'm just going to pick a number. I can only get $100,000 up front my first 12 months. So I'm short $150,000. I still have $500,000 in equity in my home, even though I've tied up $500,000 in my reverse mortgage, right? Can I then go to another bank and borrow the $150,000 short term in a second position to the reverse?
Yeah, that's a question I'd like to make sure that I clarify.
All right.
Because we have second loan options available. I don't know if they'll be willing to take that second lien holder position in a reverse mortgage. So that's a great question.
Well, so that's your homework.
That's my homework. I love homework.
So we'll have to have you back for a part 2 to get that answer, because I can see that scenario coming up. Yeah.
So I think planning is really the key if you're looking to use this strategy. And let's face it, not everybody's ready to build.
In all strategies, hopefully you plan, right?
Right. And not everybody's ready to make this move right away. It takes the daughter, Jane, to figure out, okay, I've got to sell this house,
Right.
I'm going to do this.
Well, so let's unpack that. So let's pretend I can only take $100,000 the first year. If I take the $100,000, the interest is accruing on it, but I'm not being hurt.
No.
Right? And can I still get monthly money too if I need money to live on?
It depends on how much is there.
Okay.
So it's a calculation.
Right. So this is this something that when you sit down with a client, you have a spreadsheet and you're doing live with them?
It's a specific calculation. So the first thing I do is get their age. I put a value on the property.
But I mean, you can answer these questions
Correct.
Specifically, directly, live while you're meeting with the person, saying, you're this old, the house is worth this, you want to do that. Okay, here's the numbers, and you can go right across the columns.
That is correct.
Okay.
That's correct.
All right. So that in a specific scenario, you can give people very specific answers.
It is a specific answer.
Yeah.
Yes.
Okay. Good. Once you have that initial intake and that information, you can come to my house. We can sit down at the kitchen table. You can do real life scenarios right there.
That's correct.
With myself, pretend I'm the older person. With my family member, whoever that is. If there's a kid, whatever that scenario is, you can work all that out live right there.
That is correct. And typically I ask the questions that are, what are you struggling with? What do you need? What do you think you want to do?
Right.
What feels comfortable to you? And the thing is, you can change this, Buzz. So you're not stuck to this. So once you make a decision, let's say you say, I want to take a month, I have available a monthly stipend.
Yeah.
I'm going to call it that, monthly withdrawal or disbursement of $1,400.
Right.
But I only want to take $900. And then I change my mind a year later and say, you know what? I want to take a little bit more than that. You can do that. Or you say, I don't need that much. I'm going to take less. You can change it. It's fluid, even after the loan is closed.
So they have are they contacting you for those changes, or are they going to the company?
They'll call the 1-800, the servicing department.
So there's a live person that they're talking to?
Yes.
Okay, that's a refreshing thing, right? So they talk to a live person, and they can say, I need another $300 a month, and they'll make the adjustments, and I'm assuming this is all direct deposit stuff, and it's coming right to them, right?
I mean, that's the way to do it, but
yeah.
Could they mail you a check? Sure.
Yeah, there are people, obviously, that still want checks. And I appreciate that. But direct deposit is the way to go for sure. So
without a doubt.
So the in my mind, and again, you stop me if I'm wrong, my mind, it sounds like if this is going to be wrapped in an ADU, it's going to take a little longer, especially if I'm on the younger side, to get the money necessary to build the ADU. But you're going to find out if someone else can go in short term and go in second position. So that's interesting. So let's go back to what I would consider the original purpose of this product is, as you said, that someone can stay in their house and not be financially stressed as long as they have equity in their house.
And that's correct. And here's why, right? So maybe you have to pay for the entire ADU, you may have to time it so it's over a 12-month span.
Right.
Okay? However, you've got the daughter, Jane, who's selling her house, right? Going to take and move into the larger home.
Right.
Right? Now remember, mom's not making a payment on this. So I don't know what your timing is for your deposits, but she's not making a payment.
So theoretically in that scenario, hopefully daughter Jean has $150,000 worth of equity, and that can come over here and finish the project. So the mom Jean can take 100 out of the reverse right away. Let's pretend the project's 250 for easy math. The daughter's selling her house and has 150 clear after closing. She can put the 150 over here, and now they can build the ADU.
Correct. And if she doesn't have the money for the ADU, then the balance can be taken at the beginning of year 2, right? And if that's enough, that's fantastic. And each individual scenario is different. But the key is this. So now Jane, who had a mortgage on her house.
So wait, let me stop you there. And I know where you're going, but let me stop you there. So in our scenario right now, it's impossible for the mom to take a HELOC up front because she doesn't have any income. She's on a fixed income.
Correct.
Right? So in order to qualify for a home equity line, I have to have some type of income, and I'm assuming Social Security doesn't count.
You can use Social Security, but it's usually not enough.
Right, so it's a limited amount of money they can borrow based on Social Security. So this is another scenario where we're keeping the family home in order to get it accomplished. So now go on with what you were saying. So the daughter obviously doesn't have a payment anymore on her home.
Correct.
Right, so how does that help us?
How does that help us? Because there's nothing that says that you can't make a payment on this reverse mortgage. So just because it doesn't require a payment, doesn't mean that you can't make one.
That's the interesting fact. I did not think of that.
So you could pay just the interest. You could pay the interest and the principal. So let's say you're concerned about this. You're concerned about the accruing interest and the balance growing over time, and absorbing the equity that's in the home over time. Well, you could say, all right, so we have the ability to make that payment. Why don't we pay just the interest on that? What does that do? It means that you have more cash flow instead of paying what you would owe on, let's say, a second, which is principal and interest. Right? So you could almost operate it like a HELOC. So a HELOC is typically an interest-only loan.
Right.
You could almost do this as that same function, right?
Yeah,
but you don't have to.
It's interesting. It's just another tool in the toolbox. I really like that. There's so much flexibility. I never knew. I had obviously heard about reverse mortgages, but I never really spent any time thinking about it or working with it. And I've never known anyone that took. Well, I shouldn't say that. I did know one person that had a reverse mortgage, but I didn't know the details. So let's play that scenario out a little bit further. So mom is in her house. So Jane's over here. Mom's in her house. She takes a reverse mortgage. 5 years into it, she says, you know what, I don't want to live alone anymore. I'm going to sell my house and we're going to build an ADU. So I can pay that note off anytime I want.
Correct.
So it's no prepayment penalty. So year 5, I say, you know what, Jane, I've had enough. I've enjoyed my house, but now, I can't drive at night anymore. I need to be nearer to you. You're, 15 minutes away, and it's obviously a strain on you. You're trying to do a bunch of stuff, and, the house needs a new roof. The furnace guy told me I'm probably going to need a furnace in 2 years, and I'm tired of banging around here by myself. I'm tired of mowing the lawn, whatever it is, right? So now, year 5, I say, I'm going to sell my house. Again, it's $1 million house. At that point, I've only taken $200,000 with accrued interest on my reverse mortgage. I sell the house. That gets paid off just like a regular loan would get paid off.
Correct.
No prepayment penalties. There's no penalty for that. I take my $800,000 again, pretending there's no closing costs. brokers and et cetera. I take my $800,000, I can do whatever I want.
Correct.
So there's always a downside. So what's the downside to reverse mortgage?
You know what?
Nothing's perfect.
The downside is the fact that there's so much myth about this product.
Yeah, I agree with that statement 100% because I feel like I'm sitting here saying this is too good to be true. This is what's going around in my head.
And this is what everyone says to me. All right, so at the end, when, let's say if I, live a very long time,
Yep.
Mom lives a very long time,
Yep.
stays in the house a very long time, the interest, we're going to owe more than what is owed on the property, and there's no value left in the property. Yes, that's the biggest downside. You know what the biggest plus side is to that? They're not liable for the deficit.
Right. So in that scenario, I managed to live to 105, and I owe them $1.8 million, and my house is only worth $1.5 million. The most they're going to get is $1.5 million.
That's right.
Interesting.
And it's because of the non-recourse feature. So
Right.
you got to ask me, Buzz, how does that work, right? How does that work? Please tell me. Jane,
Wait, let me tee that up for you. There you go.
All right, there we go. Okay, so how does that work? Well, it's because a HECM is
I don't like that name, by the way.
home equity conversion mortgage. I know. It's like, I know, it's not a good thing. But anyway, as a reverse mortgage is backed by FHA, which it hasn't been in the past. So what does that mean? FHA can be used for forward mortgages too.
Sure.
I'm sure you've heard people purchasing a home
Yeah.
using an FHA insured loan. FHA doesn't make loans, right? Banks make loans, FHA insures the
Insures it,
loan,
correct.
right? It's the same thing here. So it's that mortgage insurance that pays for the fact that there
Okay.
could be.
So it has built-in mortgage insurance.
That is correct. You pay it up front.
In the FHA program, so that if there is a deficit, the mortgage insurance has to step in and cover the difference.
That is correct. That is exactly how it works. And there are different versions of a reverse or home equity conversion mortgage. There are proprietary
Yeah.
ones, meaning that are provided by the lender, and then there are ones that are backed by FHA. The ones that are backed by the lender are still non-recourse, meaning that they don't have mortgage insurance through FHA, but they have a function that performs the same task.
Got it.
All right?
That's good stuff. So what did I forget to ask you about reverse mortgages? Because I feel like we beat that pretty good.
So I think one of the biggest things to remember is that when you take out a reverse mortgage, it has to be for your primary residence. But what you haven't asked me, Buzz, is how do I buy a house using a reverse mortgage?
Ooh, tell me.
So I love to bring in your ADU because I really feel that's why we're here, right?
Well,
this is a great
we're having fun.
conversation, but
Yeah, that we're having fun.
So,
but yes, it is all about ADUs.
all right. Now, to put an ADU on a property,
Yes.
why don't you tell me some of the qualifying factors? How do we know that you can get it on there? How does it fit? Tell me that.
Funny you should ask. So the first step, obviously, is to get online with myself or Paul, and we'll do what's called a site check. So we'll physically, using software, high-resolution aerial photographs that are to scale, we'll physically place the ADU on the property to ensure that it fits and there's going to be proper zoning setbacks. Okay? Then the next thing we need to figure out is the septic system going to work? Is it going to have to be upgraded? If there's town sewer, that's a huge relief. If there's not, then the septic is the next wild card. So assuming we can get the septic to work and physically put the ADU on the property, either attached or detached, then at that point, it is a candidate for an accessory dwelling unit based on the formula of 50% of the main living area, gross floor area of the main house. So assuming you have 1,800 square feet, a gross floor area, you can build up to 900 square feet of ADU. So if you have a really small house, if you have a small 1,000 square foot ranch, you're probably going to limit it to 500 square feet of ADU. However, the law says gross floor area, and it specifically says the basement counts. So
Okay.
if your basement in your little 1,000 square foot house is over 6 foot 8 inches high, you can count that square footage towards your gross floor area.
Wow.
So now I have a 2,000 square foot, primary residence, minus the thickness of the walls, so call it 1,900. So now I'm at 900 again. So I could have a physical 1,000 square foot footprint of a ranch.
Sure.
And then I could build a 900 square foot footprint of an ADU if I have a full basement over here.
Okay.
So keep that in mind. So that's the main criteria of an ADU.
But it is entirely possible for there not to be enough setback from the street?
100%.
Okay. So now we've got mom and daughter who decide that they are going to make this work, right?
Mm-hmm.
Daughter's house, or maybe the daughter doesn't have a house, the mom's house doesn't fit the ADU
Yeah, they're on a real
qualification.
small lot.
They're on a real small lot.
Wetlands,
just
whatever it is.
Isn't going to work,
Yep.
right? So now what do? They go look to buy something, okay?
Okay.
All right, so they go look to buy something where it will qualify, because you can do that almost immediately by looking up a property address, right?
Correct.
All right.
Yeah.
So
In an hour or two, we can tell you if it's a good candidate.
So mom and daughter are out looking for a property. Mom's going to sell her house, okay? And let's say that's worth $850,000.
Let's use million. I like a million.
All right, $1 million. I love $1 million too. So let's use $1 million, right? Mom's house is worth $1 million, and they're going to go find something. Well, they can find something that maybe is $1 million property that's suitable, has enough land that qualifies for an ADU. But if they use all that $1 million, well, then it's all in that property.
Right.
What if they only had to use, let's say, 750, and they could reverse the balance of that? Meaning that they leave the sale of the house for $1 million. They only require, let's say, 750. Now they've freed up that 250,000 to build their ADU.
Got it.
Right?
Mm-hmm.
And it works just like the reverse mortgage would on the primary residence. It is the primary residence.
On the new primary residence.
new primary residence. Right? And so, of
So
course,
you don't have to, the short answer to that is you don't have to live in the house you currently live in now to take a reverse mortgage.
it has to be for your primary residence.
Understood, but
Yeah.
you can take that equity and move it over here to a new location and take the reverse.
Correct. Right.
Interesting.
Reverse for purchase. H4M. Heckham for purchase.
You're killing me with these acronyms. I need charts and graphs and an easel.
So, as you said, everything has its ups and downs.
Right.
The majority of this is an upside. And it's an upside for options for, number one, real estate agents, right? Because what did I just do in that scenario, right?
Hey, you had 2 houses got sold
2 houses got sold.
and one bought.
And one purchased, right?
And we built an ADU.
And you built an ADU.
I like
I did
it.
a little financing in between, right? So, I mean, it's all a good scenario.
So that's a lot of tools in the toolbox.
It certainly is. And
Yeah.
it's very, and I hate to say this, it's customizable because it really depends. What's the age of the borrower? What are they buying? What are they selling?
Now, let's touch on that. So I'm 70 years old. I'm in very poor health. It doesn't matter. They
Doesn't
just
matter.
look at the age.
Has nothing to do with
So I could literally, unfortunately, have terminal cancer and decide I want to do this, and all they look at is the age. There's no medical checkup. There's no health reports.
Of course, you have to be of sound mind and body.
Right, but you have to be alive.
Correct.
Right?
Yes.
And you
Well, I
can't-
hope so.
Yeah,
Yeah.
but I'm saying you could know that you don't have much longer to go, and you're doing this for a reason,
Sure.
and you could do it. So there's no medical checkup, no health exam, a nurse
No.
doesn't come.
No.
Just driver's license, okay, you're 70 years old.
That's
This
right.
is the formula.
That's correct.
Okay, that's good. I think that's a good point for people to know. Because, obviously if you're trying to get, life insurance, there's a whole other, there's a lot more layers to that than, just your age.
So that brings me to a good point, because the question is, when does this get repaid? And it's when the homeowner no longer uses that property.
Right, so it could be
So
by sale or by passing away.
that is correct. And they have
Right.
6 months to satisfy that debt.
Okay,
right?
so the heirs,
Yes.
so unfortunately mom passes away, and they have 6 months to get that property sold.
Correct.
What happens after 6 months? What can they do to you?
The lender will foreclose.
Okay, so they'll force the sale.
Yes.
Right. So they're giving you 6 months to get your act together, get on the market, get it closed to another buyer. If you don't, they're going to take it to auction and sell it on the street corner.
That is correct.
Right. And that's bad for you because you may lose a lot of equity that's still left over.
Well, no, you'll get the difference.
Yeah, minus their fees and a
Correct,
bunch of other
correct,
stuff, the
correct,
auctioneer's fee,
correct.
et cetera. Right.
Yeah, correct.
Right. So, again, obviously nobody likes to see the house get auctioned, but there is a way out of it to get that debt satisfied and at least get some of the trapped equity remaining in the property.
But you've got, daughter Jane and mom, right? Daughter Jane lives in the main house. Everything's still in mom's name, right?
Right.
Remember, because it's mom's the primary
Yeah,
residence, right? So everything's still in mom's name. Daughter Jane lives in the house. Mom lived in the ADU. Mom passes away. Daughter Jane doesn't want to sell the house. She still wants to live there. You know what she can do? First of all, she does have to pay off the debt, which she can do with a refinance.
Yeah, she can go refinance with Right Key Mortgage.
That is correct.
Yeah.
That is correct. And she can also collect income from that ADU.
Yes, now it's rental, and that can count towards her income for her payment.
And it also helps, it just helps in general.
Right? Yeah. So if you're getting $2,500 a month for rental on the ADU, that goes on the mortgage application saying this is going to rent for, $2,500 a month. And I also make my job, and here's all my other income, so that's going to help satisfy that debt, and now we can get into a conventional mortgage.
That is correct.
If
Have
we
you
want.
done this before? It sounds like
Yeah,
you may have done this.
once or twice, a couple times. Go easy. So there's a lot. So again, just to unpack this for myself, the secret to all these scenarios is having someone that is creative and understands how all this fits together, that can sit down and advise you on these are scenarios that I see. It's not just one size fits all. We can do this, we can do this, we can do this. Here's the upside, here's the downside, here's the drawback, here's the long-term scenario. Mom eventually passes away. How is Jane going to afford the house? Okay, so she's going to rent the ADU, and that's going to help her, refinance and not have to leave the house.
Correct.
Right. So that's really good stuff.
And I think that one of the things that, we need to remember is that there's no payment with this. Right.
The whole time that
Right.
Mom and Jane are living in the house, if
There's
Jane
no
has
payment.
If Jane has a job, she can be saving up a whole bunch of money to when and if that day comes, that's her down payment.
And the misconception is, one of the other misconceptions is, well, this is for people that don't have any money. This is, we talked about scenarios where people couldn't, pay their bills, couldn't make ends meet, and it worked out as a great option for that.
Yeah.
But what about if you don't want to use, you want to build the ADU, and instead of putting that whole $1 million down on the house, and then now taking $250,000 or $300,000 out of what you have saved, you don't have to do that.
Yeah, no, it makes sense. Let's pretend in that scenario, Jane's mom has an annuity or something that she's getting payments from, or she has investments, and instead of liquidating those investments to live on, she taps the equity in her house so that her investment portfolio can keep growing.
That is correct. That is correct.
Yeah. Very interesting. There's a strategy in there.
And it really depends on each individual borrower.
100%,
I keep saying that
Yeah.
because
No,
it's
I
so
understand
important
it.
to
This is
understand
very a la carte. One size doesn't fit all. This is very, boutique. You have to understand all the scenarios. You have to play out all the scenarios on paper and talk about all the issues and make sure that everybody understands exactly what they're doing. And then also, like you said, you need to do some long-term planning towards, okay, what ifs, right? And we can never know for sure, but at least we can try to make a guess at what's going to happen, right? I mean, for all we know, Mom was an early investor in Bitcoin, and she bought it at 8,000.
That's right.
Right? And now it's at 105 today, or 107, whatever it's at today. And 10 years from now, it's at $1 million. maybe that was the right move because she left that money in Bitcoin rather than taking it out, and she only borrowed $400,000 of her $500,000, but she's made $20 million on her Bitcoin.
That's right.
She can then take that and pay that off, and it was still a home run.
It's all about the strategy, right? So depending on that individual, that borrower that has those investments, why not let those investments grow? And when she passes, those investments pay off the balance.
Yeah, 100%. So you have to, when you're exploring these, what I would call,
scenarios.
Scenarios. Good word. Thank you. You can't be of the the old school mindset. I'm going to take a mortgage. I'm going to make my monthly payment, and someday I'm going to pay it off.
That's right.
Yeah.
And
with all these tools, there are a lot of scenarios to work through, to be creative, to allow people to enjoy their house and to not be skipping meals.
That's right.
If they're down to the last nickel, or they have a sizable investment, portfolio, and they don't want to disrupt that, they can tap the equity in their home and still enjoy themselves while watching their investments grow.
Absolutely correct. The last one I did, the woman was so excited to be able to go and buy a lobster.
Yeah.
It
makes sense because
the little pleasures.
And in that scenario too, if you have an investment portfolio, and again, let's pretend that I'm just going to use Bitcoin, and I bought at 8 and it's up to 104,000. I don't want to liquidate that to live on. I want to leave it alone. I'm going to pay taxes on what I liquidate, so I'm going to lose whatever 30% of that if I liquidate to have money. It's better off to take the money over here and let that continue to go up if I'm convinced that's going up. Which if I bought at 8 and it's 104,000, I'm probably pretty convinced it's going to keep going up.
That's right.
Right. So it's important for all those scenarios to be talked through.
So if somebody has a financial advisor, that's something that I would obviously
So as anything, and I tell everyone this with you need a team, right? You need your mortgage lender, you need your financial advisor, you might need an elder attorney, you need a broker, you need a builder, depending, if you're building something, obviously. So you've got to have people around you that are working together as a team and looking out for your best interest.
For sure.
Yeah.
And I think that one of the things that, like I said in the beginning, that, the idea where the interest accrues over time, and people say, the interest is accruing over time, it's chewing away at the equity. Okay. Either you pay the interest before on a monthly basis, or you pay it later. One of those two. It's the same interest. It just depends on when you pay it.
Right.
So
but in that earlier scenario, if Jane was paying $2,500 a month for her house, and the interest over here was only $1,200, she could be paying the interest all the way along.
Of course.
And still be ahead.
Of course.
Right. So there's a lot of, and again, there's no prepayment penalty, so there's a lot of upside to that. I think that's key. I guess in my head, I always thought that reverse mortgages had a prepayment penalty, so obviously I was wrong about that.
They may have in the past, and they had a lot of, I will say this, the reverse mortgages or the home equity conversion mortgages of today are not the same as the ones of the past.
Got it.
Right? And they've made a lot of improvements. One of the first thing is that the borrower must take a class. They have to, it's probably about an hour long, over the telephone. They have to pay for it, and it's because the government wants the borrower knowing.
You didn't tell me this little fact.
Well, it all comes up as we roll along here, Buzz.
All right, so now I'm in the thick of it, and I want to do business with you. Tell me about this part. I have to have some formal education about what I'm getting into.
You do. You will have to take.
That's really good idea. So tell me what that's, roughly, what does that sound like? What does that look like?
So the cost is, let's say, between $150 and $200. The borrower has to pay for it. I can't pay for it.
All right. So Visa or MasterCard?
Yes, Visa or MasterCard, debit card. It can be done over the phone. It can be done in person. And it's really about the borrower understanding what they're signing.
Right.
In a very, very simplified format so that there's no question about the loan officer coercing or taking advantage of somebody who's older, right?
Yeah.
This is all about third parties that have nothing at stake except for educating this consumer and letting them know what this is all about and how this works. And
Yeah, that's
answering their
really good.
questions.
I'm glad you brought that up. Because I was thinking to myself that, God forbid this person doesn't have any trusted family members, and they're 75 or 80 years old. They got to be careful, especially if they don't have any trusted advisors. So, or they they're not as sharp as they used to be, right?
That's right, and that's what that course is about, right? To make sure the first of all person understands what they're doing, right? That they are of sound mind, and that they understand the documents that they're signing, and they take them through all the same documents that I would show up with initially when you call me and say, hey, I'm thinking about doing this. Can you tell me how this would work, right? And so that is the very first step, and that's why some of these loan products are not the same as they were from early 2000s, early 2000s, 88s, when people would end up upside down and the heirs would owe more on the property because of this non-recourse feature. It's just they've really come a long way, and they have a really great place for the right person.
So again, it's a tool in the toolbox. So we're going to reach out to Jane at Right Key Mortgage and say, Jane, I need help, and you're going to bring your toolbox and you're going to figure it all out.
That is correct.
All right, so you obviously do other things than reverse mortgages. So let's talk about what are the tools you have in your toolbox.
So we do have lenders that offer HELOC, right? So what's the difference between a HELOC and a second mortgage?
So a HELOC is a home equity line. I'm keeping up with my acronyms here, right? So I'm finally getting up to speed. And my second mortgage is behind my primary mortgage. Those are the two definitions. Beyond that, the second mortgage is a fixed payment, typically, right?
Correct.
Monthly interest. I hope I passed this test.
Wow. And I'm going to give you an A at the time that this is done. I'm in trouble now.
And then my home equity line is typically flexible, so I can take as much money as I want. So if I have a $500,000 home equity line, I can literally write a check for $499,999.99 and use it all at once, or I can write a check every week for $500, and I'm only paying interest on the money I've borrowed.
Correct.
Right, and I have the ability. So if I take it all out and I go to Mohegan and put it on red, and I double it, I can pay that off with no penalty.
That is correct.
I can pay it back down to zero.
That is correct. Very good. Here's one of the so home equity line of credit, you can borrow against it, right?
Yep.
It's usually an adjustable rate, could be fixed for a period of time,
okay.
But it's usually an adjustable rate.
Yep.
There could be a minimum draw, right? So minimum draw of, let's say, $25,000 or something like that at the beginning, depends on the program.
So I have to take a little money right off the rip.
Yes, but that doesn't mean that you can't pay it back right away.
Yeah,
right?
So 2 weeks later I can turn around and put it back in.
Exactly.
Because obviously they're not making any money unless you're borrowing money.
Correct.
If you have money out on the line, right?
Correct.
And if you have a $500,000 line, they have to keep that money available to you to borrow whenever you want. So we're tying up some of their loan capacity by not taking money on our $500,000.
Correct.
Right.
Correct.
Okay.
And you're right, with a second mortgage or a second lien holder position, the borrower pays both principal and interest as part of the loan. The key is that, typically with, a home HELOC or a second mortgage, it depends on how much they're going to let you go. So we have a HELOC program that allow you go up to 90% LTV, 90% loan to value, which is pretty high, right? You go to a local bank, it's probably going to be 70, 80, something like that. FHA would be, any cash out refinance, they're going to be 85%. So we do have programs that will allow you to take more out of the equity than some of our competitors.
Okay.
Yeah.
So we have reverse mortgages, we have HELOCs, home equity lines of credit, we have second mortgages, we have regular first mortgages.
Oh, you bet.
What else do we have?
Boy, we even do some construction loans, believe it or not.
Okay. All right. So construction loans can be in all shapes and sizes, as we know. So it sounds like to me, and you tell me if I'm wrong, I call up Jane from Right Key Mortgage and I tell you this is what I'm trying to do, and you're going to work through your toolbox to help me get to the best scenario.
That is correct.
And I can do this over the phone. I've got to come see you. What does that look like?
You can do it over the phone, depending on where you are and where I am. We can certainly do it in person at our office over in Easton. Most of the time, I end up talking with somebody over the phone, doing most of it electronically, or going to their home. With reverse mortgages, I tend to end up at people's homes a little bit more.
Yeah, there's a lot more talking points around that, obviously.
And in today's world, everybody is pretty used to doing things electronically.
Right. So you'll send them a sheet or whatever they need to help and fill you out and get the information they need, right?
It's all about asking questions.
Okay.
All about asking questions. Ask the right questions, you'll get to the answers that help the consumer. That's entirely what this is about, right? And
Right.
you do this with building your ADUs, right? You created some models based on, common sense, right? I want the bathroom a little bit bigger so that if you need access for a wheelchair and those kinds of things later on in your life, right?
Yeah.
So it's about being able to have a little intuition and work with the borrower and say, where are you at today? And what are you doing? Where are we going to be? Like, what's our plan?
Yeah, those plans, I agree with you. Those plans have evolved over the last 7 months from a lot of phone calls and Zoom meetings and in-persons and looking at plans that were provided by homeowners that, downloaded online and exploring what worked and what didn't. And so, yeah, that's a good point. All right, we're going to go to the lightning round.
Oh, no.
So, rapid fire segment. Favorite tool you can't live without, and it can't be your phone.
Leaf blower.
Leaf blower. All right, back to our landscaping roots.
Yes, that's right.
Yep. Industry trends you are noticing.
Aging in place. Aging in place. That's what I'm seeing.
Yeah. Dream project you'd love to work on. Can be any project.
Buying a bigger boat. Anyway.
Okay. All right. If you could have dinner with anyone, dead or alive, who would it be?
Ooh.
This is a new question.
Dinner with anyone, dead or alive, who would it be?
They would be alive while you had the dinner.
Oh, well, that's good, because that would be a little disruptive. But anyway. Michael Jackson.
There you go. MJ. Now, early Michael Jackson or older Michael Jackson?
Probably older Michael Jackson, because I have a feeling he has a lot of stuff to talk about.
That could be true. Best piece of advice you'd ever received?
Wait 24 hours before you
Make a decision?
necessarily say something you might regret.
All right. That's a good one. You have $10 million to donate. Where does it go?
$10 million to donate.
This is a new question.
Well, I appreciate all the new questions.
Well, it's only two. This is number 2.
$10 million to donate. I think I would donate that to...
It can be multiple.
You know what I think I would donate that to? I think I would donate that to education and financial literacy for teenagers and schools and academics. Because I think that's a section where we've got so many young people that have no idea how to manage their money or what that means. And in my world, I see that a lot.
I bet.
So I'd like to see more education towards that. And I realize that that's not a true charity, but I'm creating my own charity.
No, actually, I think actually Dave Ramsey actually has that charity.
Oh, does he?
Yeah.
Really? Wow.
Yeah, I think he does. I'm 80% on that. Advice you would give your younger self?
My younger self.
Yeah. Baby Jane.
Baby Jane. Nobody puts Jane in a corner. Anyway, advice I would give my younger self would be... I think it would be how much younger? How much younger?
You can go back as far as you want. This is your scenario.
I would say, my very younger Jane, I would say, be believe in yourself. Believe in yourself. Don't let other people tell you, what's right and what's wrong. Inside, you know what's right and what's wrong.
Awesome.
And act on that.
All right, and the last one's a fun one. Favorite food?
These are all so much fun. I can't stand it.
Favorite food and dessert?
Favorite food, I'd probably pick, let me see, a really good ravioli.
Okay. Filled with something?
Just regular ravioli,
Okay,
homemade
all right.
sauce.
All right.
Some good meatballs on the
Okay.
side, and
All right.
and then favorite dessert would be key lime pie.
Ooh, key lime. We haven't had that one yet.
Yeah, light, refreshing, right?
Yeah,
It's
good stuff.
with summertime coming up, so I think it's all good.
Yeah. All right, that's a wrap for today's episode of the BuildX Podcast. Thanks to Jane from Right Key Mortgage for joining us. Please subscribe, like, and share if you'd enjoyed it. See you next week. And remember, Jane, just build, baby.
Just build, baby.
That's a wrap.